We're at the FundForum Asia in Hong Kong, and I'm talking to Peter Marber, who's head of emerging markets at Loomis Sayles. Interesting times in emerging markets. Obviously, we've got the context of everybody's wondering what the Fed will do in terms of interest rates and tapering and when. But clearly, this has huge implications for emerging markets. We saw the taper tantrum 2 years ago. Now we're left with equal uncertainties. Where do you think the most interesting pockets of opportunities are in emerging markets?
Well, the potential rise in interest rates in the U.S. Could continue to make the dollar stronger. And a stronger dollar means weaker EM currencies. And at least for U.S. investors, that would have sort of negative implications for even emerging market stocks, because we always have to remember that local stocks are denominated in local emerging market currencies. So that might not necessarily be the best place to be in the foreseeable future. But I think one interesting area is emerging market credit, and that would be the hard currency bonds denominated largely in dollars that are issued by both governments and corporates out in emerging markets. So we now have about 70 countries in emerging markets, from CCC rated all the way to AAA. We forget we even have AAAs in emerging Singapore. And they actually offer investors kind of a rich opportunity in the bond space.
And you're not just talking frontier then, you're talking pretty mainstream, available, interesting investment opportunities in EM, which I guess you feel are under-invested in right now. Why is that? What is it that's lacking in terms of investors actually going for that search for yield?
Well, I think that all the headlines doesn't do emerging markets all that much good. You know, you have a potential restructuring in Ukraine, you have Venezuela that's teetering on a default potentially, but if you look at the bulk of the countries in emerging markets, they're mostly investment grade. They actually are incredibly solid financially and economically. And if you look across the rating spectrums, you know, say single A rated bonds from US industrials, and then you look at emerging markets, single A rated bonds from either governments or corporations, you know, emerging markets is actually paying a premium right now of, you know, very close to 100 basis points. In triple Bs, it might be 150, and as you start going down further into high yield, it might even be 2, 3, 4% more than the equivalent that you'd find in the US. So I think that amid quantitative easing and the zero interest rate policy, you know, a lot of people are searching for yield. And it's pushed a lot of money in the stock market. A lot of people have been speculating, but I think that that's led to unbalanced portfolios. I don't blame people for looking in the stock markets, but actually emerging market debt could be an interesting sort of safe haven, believe it or not, for people's portfolios. It could help them rebalance it a little bit more towards the debt side.
Bit of diversification geographically and in terms of asset classes. And I guess as we were talking earlier about this interesting erosion of the home bias, perhaps, that's come out of the whole upheaval of the last few years. Maybe just a word on what are your favorites? I mean, you mentioned there's some emerging markets who've got a lot of big issues, others that perhaps investors ought to be looking at much more closely. Can you give us a handful of favorites?
Well, I think that right now, our bias in terms of countries is there's a fair amount of Chinese dollar bonds that are out in the marketplace that we think are interesting in both the high yield space as well as the investment grade space. We're relatively bullish on India. You don't hear people talk too much about it, but we really like the reform story there, including a new president, new finance minister. I think that Asia in general is probably where you'd like to bet for the next few years, because the story there is we see is pretty good, because the fall in commodity prices will be something of a dividend to those economies, because they're very reliant on commodity imports.
Great. Well, thank you very much. We'll leave it at that. Thank you, Peter Marber.